Today, we're unpacking how a US company can coordinate with existing businesses in the Bahamas without outside investors at the start, while staying compliant and making smart decisions about taxes, ownership, and reinvestment. We'll keep identities private and focus on clear, actionable steps you can use right away. Question 1. What's the high-level structure we're aiming for? A US company receives client payments, while the Bahamian businesses perform services on the ground: concierge, butler, transportation, food. If the US entity owns Bahamian entities, profits from those Bahamian entities flow up to the US entity. Question 2. What happens tax-wise if the US company owns the Bahamian entities? The US entity must report the Bahamian income, expenses, and resulting profit on its US return. That profit is taxable in the US once reported by the US entity. As a baseline, plan around standard US corporate tax rates on those profits. Question 3. Are there extra taxes if money is distributed to the owner? Yes. Dividend distributions can trigger additional tax at the shareholder level. Practical takeaway? Consider timing and amount of distributions as part of your tax planning. Question 4. Is there a way to lower the US company's taxable profit without breaking the structure? Use a contract model. The US company subcontracts the Bahamian companies for services. That creates legitimate expenses in the US, reducing US profit and income in the Bahamas. In plain language, US expenses equals Bahamian income for the services delivered. Question 5. Can the US company fund growth in the Bahamas, vehicles, equipment, properties, using business profits? Yes. Profits can be cycled to acquire shares or provide intercompany funding, so Bahamian entities purchase long-term assets locally. This supports operations and, if structured properly, can align with tax-efficient reinvestment. Question 6. Does buying another company help reduce taxes? Only if the acquired company carries losses you can legitimately use. Buying a profitable company generally increases consolidated profit and taxes. Question 7. What about asset purchases and depreciation? Large fixed assets, e.g., office/house used for operations, create depreciation deductions over time. Depreciation can reduce taxable profit gradually across multiple years. Question 8. Are there sectors in the Bahamas that can't be majority foreign-owned? Transportation often requires Bahamian majority ownership under local licensing rules. In restricted sectors, use a service/contract model instead of direct majority equity. Question 9. If the US can't own the transport company, can we still align the group financially? Yes. Have the US entity contract the transport company for services to serve your clients, treated as an expense at the US level. This keeps operational control via contracts without violating ownership restrictions. Question 10. What's the simplest baseline playbook? The US company invoices clients. Bahamian companies deliver services and bill the US company, creating US expenses. Where allowed, weigh partial ownership versus pure contracting. Remember, ownership tends to pull more profit and tax into the US. Start with the contract model to manage US tax exposure while you build capacity in the Bahamas. Where ownership is permitted, weigh the cost of consolidating profits in the US against the strategic control you gain. Reinvest profits into durable assets that support long-term cash flow, and remember that distributions to owners may carry additional tax. This structure helps you scale now, stay compliant, and position for outside funding later if you choose.